It's been a good couple of months for stock markets, bouncing back after what has been a really tough year. The S&P 500 has rebounded around 17.5% over that time, buoyed by the prospect of slower tightening from the Federal Reserve, potentially starting as early as next week with a 50 basis point rate hike, and then hopefully continuing into the early parts of next year with fewer and fewer rate hikes again until we get to that terminal rate, at which point we will hopefully start to see some stabilization in the economy and maybe even the prospect for a rebound maybe later next year. A lot of ifs, buts, and maybes, of course, and as we've learned this year, it's not always straightforward and very difficult to foresee at times of such uncertainty like what we are living through right now. But investors have been a little bit more optimistic. Like I say, over the course of the last couple of months, we've seen some more promising economic data, like with the CPI and PPI figures that we've had over the last month or so. Also, the softening of a tone from the Federal Reserve. The jobs report on Friday was a massive setback, and you can see that reflected in the performance of the US stock markets since then, most notably the wage growth figure doubling market expectations. So the markets were forecasting around a 0.3% rise. It was actually 0.6%. The reason why that's so damaging is because really that is what feeds into the entrenched inflation outlook that the Fed fears so much. We're likely to see CPI falling quite considerably over the course of the next 12 months, driven by a combination of factors, including favorable base effects, but also lower energy prices, lower food prices. But the Fed fears entrenched inflation, which is driven by more sustainable factors like large wage growth. And we've seen that for most of the last year, but the hope was that it would start to ease with a loosening of the labor market and higher interest rates. And we were starting to see signs of that happening, but that wage growth number last month and the upward revision to the month before really was a massive setback, and it's going to feed into those fears that already exist within the Federal Reserve. Now, it's not going to mean, in all likelihood, that we're going to see higher rate hikes than we're currently anticipating, starting, like I say, next week, but it could ultimately mean there's a higher terminal rate, which means more rate hikes throughout the first quarter of next year. Of course, this is just one report, and there is going to be other data like the CPI figure next week that is going to feed into these inflation expectations and ultimately interest rates. But it, like I say, it was a massive setback after such a strong bounce back. The bounce back around 17.5%. This follows the S&P 500 falling by more than a quarter since the start, since the peak earlier on this year. So let's take a look at that chart. You can see here, this is the S&P daily chart. We've had a bit of a downturn over the last week, which I've already alluded to. It was interesting that this actually coincided with a run into that 233 day simple moving average band. You can see that's been a real strong area of resistance really since the early part of this year. We briefly traded above here in late March, and that was a point at which we saw the of course the invasion of Ukraine, and we saw sentiment turn south quite quickly after that, and hasn't really ever fully recovered. But since then, we have seen the 233 day simple moving average band act as resistance. We've seen that once more, and that coincided with that jobs report. It also roughly falls in line as well with the 50 fib, which is the year highs to the year lows. So again, we are now entering into key retracement zone. If what we are seeing is a retracement rather than a full recovery, then you would expect to start seeing resistance here. Even if this is a recovery, this would be a logical area of resistance as well for any temporary corrections. Now you can see we're seeing a little bit of support around 3900, 3920. You can see that this was resistance back in late October. You can see it's been support throughout November as well. So you're potentially seeing the neckline of maybe a double top, triple top, maybe even a head and shoulders forming here. So that's going to be an interesting area to watch as well in case we do see a broader correction to the downside. A lot of people referring to the recent price action as being a bear market rally rather than a recovery in a much more broader sense. So that's going to be an interesting narrative to follow. But ultimately, I think a lot of this now falls on the next week in terms of which way we are breaking. Are we breaking the 233 day simple moving average band, moving back into more bullish territory, or are we going to see a break of that 39.20 and move into a deeper correction at the very least of that 2-month recovery rally, which we've seen since mid-October? There's a lot of data to come, and obviously that big Fed meeting on Wednesday. So that's the PPI on Friday, CPI Tuesday, Fed Wednesday. The outcome of these three things is going to determine which of these if either break and how we are ultimately going to the end of the year. Are we going to see a big Santa rally into the end of the year? Or is this going to be one of those years where stocks just can't gather any upward momentum and we move into the end of the year on a bit of a lull? It's going to be really interesting to see, but clearly those 2 data points and the Fed meeting next Wednesday is going to be a pivotal driver one way or another.